Now we're there.
Now we're there. We needed Jamie Satterfield to be on. So does he get a tardy there, Professor Forehand?
He's been busy.
Okay. Well, busy's good. So hey, Tom Deutsch here with Symmetry Financial Group, direct to George and Janet Matthews, key leader with the company, and kind of honored to be given the opportunity to participate in this DFL presentation with senior analyst and agency owner Scott Forehand. Just a little bit of background about the Debt-Free Life program here at Symmetry. It's a, I guess for lack of a better word, a Symmetry original. It's something that we started a little bit over a year ago because we saw a need for a lot of our clients, since we specialize in mortgage protection. They all have debt to help them get out of debt. And the more we learn about this, just the more fascinating this tool is to help people achieve a better lifestyle. To put things into perspective, I lost my note here. Hang on a second. And Scott, you're going to have to update me one of these days. But as of June 1st, because I know now we're almost the end of July, when all of the Symmetry plans are put in place and executed, we will reduce our clients' debt by $755 million. They will avoid paying $243 million in interest, and it's going to improve their retirement to the tune of $2.18 billion. Now, as far as Scott Forehand goes, Scott started working with the Debt-Free Life program right out of the gates. As of the last time he updated me, there were 60 families. I think we might be closer to 70 now. I'm not sure because I know you're doing a couple a week. When the plans are completed, $35 million in debt eliminated and $100 million added to his client's retirement. So these are plans that we set up with our clients not to leave a burden with them, but to help lift the burden. And I know personally myself, putting my own plan in place has actually helped me sleep a little bit better at night because I can see an end in sight. And once I'm through it, my life is going to be better. My son is doing this with his student loans. I have another son who can't do it yet because he hasn't graduated, but he graduates in December, and the very first thing he wants to do is to put one of these in place. So without any further ado, I want to go ahead and introduce Scott Forehand, Senior Debt-Free Life Analyst and agency owner.
Thanks, Tom. A couple of just housekeeping things. Two updates. First off, I've been making this announcement so that everybody understands the importance of it. The Secure Act was enabled this year, and it creates a significant retirement issue for people that have traditional 401ks and traditional IRAs where they've wanted to pass that on to their spouse or their family member. Previously, you could take it for the life of the spouse or the family member, but now you're limited to 10 years. So that's a significant reduction in the capability of those plans to operate the way they were originally designed. Next, the CARES Act, which was enabled this year because of COVID. The CARES Act is a great place or a great source of potential money to use for funding these plans, because at this point, if you've got a 401k or an IRA or any of those other retirement vehicles where you have to wait until you're age 59 and a half to take a distribution or wait until you retire to touch it, the IRS just removed the restriction on that, and you can actually take it without penalty now early. In addition, the CARES Act also says if you want to actually take a loan from it now, that the loan interest is going to be 0%. And you have 3 years to pay it back as long as you can show hardship due to COVID. So there's a couple options there for you. One of the strategies would be take money out of your 401k as a COVID hardship, put that money up into your DFL, let it sit there for 3 years, take the money back out in 3 years after you got all that growth, throw it back up into your original IRA and not have any penalty, not have any tax, not have any interest, and have your money working for you in two places at one time. Next, let's get going here. The reason why you are here, I'm going to go ahead and start the presentation. Hold 1 second, please. There we go. Reason why you are here is that someone invited you. That could have been maybe an agent, broker, or underwriter from Symmetry, or perhaps you're one of my clients. or perhaps you're just an agent looking to get a little better understanding of this. Anyway, regardless of the reason why you're here, welcome. This is Debt Free Life. My name is Scott Forehand. In the parlance of Symmetry, I'm an agency owner, and I'm direct to Janet and George Matthews. And Debt Free Life, Tom already touched on it a little bit, but what is Debt Free Life? Debt Free Life is a proprietary Symmetry product. It's unique to Symmetry. It became available in June of last year, 2019, so it's relatively new. The concepts behind it are not new, however. They've been around for 100 years, and this is something that's been used many, many times in different iterations from different individuals, but mainly not for the general public, because it traditionally wasn't available for the general public unless you had a significant amount of money to use this program with. Who is this program designed for? It's really designed for anybody that has debt or has a concern about maybe not having enough money for retirement, or would just like to soup up their retirement. So let's move forward. First two questions we typically ask are you 100% sure that you're going to have a nice retirement? Most people, actually, I don't know anybody that can say yes to that, really. And the other question we typically ask is, if I could show you how to get out of debt in 9 years or less, would that be interesting to you? That really is kind of the number is incorrect. It's certainly 9 years or less is what we see the majority of the folks that we do these plans with. It's what it works with. But really what I'm seeing is it gets people out of debt 15 to 27 years early. And that's even more important number, because I've seen this program work for people to get them out of debt in 2.3 years, which is amazing. And if you're thinking that, the only thing I have is a mortgage and it's going to be 30 years, well, this program should get you out of debt about half that time without you spending more money. So let's move on. What is Debt Free Life? It's a play on words. We're using life insurance, not what your normal thought of is life insurance, but we're using life insurance as a vehicle for this, and we're using the debt. We're turning debt on its head. We're using debt as the fuel for our engine to get you out of debt, and I'll explain more as we move forward. If you're here like me, you're probably a traditional American household. You have thought that you were saving appropriately, but you're only saving about 3% of your income for retirement. And if you can think right now what you're spending to live your life is 3% going to be enough to live your life when you're no longer working? And of course, nobody can answer that question yes. The other issues that we have as Americans, because we're taught from the very beginning, it's okay to take on debt. It's okay to, as you make more, spend more. And in that process, as we take on more debt, we're paying more interest on the debts. And certainly this was not our forefathers' intention, but we are now about 40% of every dollar you make is being spent just on taxes, whether it's income tax or property tax or food tax or whatever, it's some kind of tax. And then the last little sliver that you see there is 23%. That's your lifestyle money. That's what you're using to pay your bills with, to put food on the table. And if there's any money left over, maybe pay your Netflix bill or your Hulu bill just to have some entertainment. This is absolutely not the way that this country was set up, and not the way we should be. And that's one of the reasons why Debt Free Life exists, and that's what we're here to talk about today. So moving forward, as a traditional American, we make plenty of money. The average American makes about $2 million in their lifetime. That's enough money to do pretty much anything you want to do if you spend it correctly. The problem is we are not taught how to spend money efficiently. And in the end, at the end of the game, when we're done and we're retired, the average American only has about $60,000 saved up for retirement. And the only other resources they have is potentially the equity in their home and their hope that Social Security is still going to be there 5 years, 10 years, 20 years from now to be able to provide some kind of income stream. And for me, I'm not comfortable trusting the federal government with that. I've heard so many stories, just as I'm sure you have, that Social Security is going to be bankrupt in 2030 if they don't do something about it. And the only thing they can do is raise taxes. So for all of us that had money in a 401k with the thought that we were going to be able to take money out later in a lower tax bracket, that thought process is probably correct. We might be in a lower tax bracket, but I would bet money with anybody that you're definitely not going to be the lower tax rate, which is the more important number. So moving on, the traditional approach, when you approach somebody who who classifies themselves as maybe a debt consolidation expert or a debt elimination expert or a credit counselor. They're going to give you a couple of suggestions about how to get out of the predicament that you're in. Work harder, spend less money, go eat ramen and tuna fish, save more, consolidate your debt, meaning that instead of having multiple little debts, you've got one big debt. That doesn't really do anything for you. Refinance. Why in the world would you refinance your home to pay off debt? That means you're taking equity and giving equity to something else, like a credit card, that doesn't owe or doesn't have any right to the equity in your home. So that's, from my perspective, that's a silly method. The only one on here that traditionally works, as long as you execute it correctly, is the debt snowball. That's been around for a while. It's not anything new. It's not a new concept, probably about 20, 30 years. And it does work. But most people have a misconception about what a true debt snowball is. And most people, what they think of as a debt snowball is actually called debt stacking. And they are not the same thing. They will both work, but debt snowballing, true debt snowballing, works more efficiently. And remember, the whole idea here is what we're trying to do is we're not trying to create bills for people. We're not trying to do anything other than get you out of debt. And one of the ways we're going to do that for you is show you how to spend money more efficiently. So moving on. Here's our better way. We're going to eliminate the debt in nine years or less. Nope. We're going to eliminate it in 15 to 23 years sooner than what you were anticipating without you spending any more money. We're going to find that money in multiple places. We're going to find it where you're spending money inefficiently, paying $50, $100 more on a debt that you don't need to. We're maybe going to look at replacing some life insurance that's inefficiently spent. We're maybe going to look at you overfunding your 401k, where you're putting money in to lose money in its current situation. All these places are places where we're going to find money. And then maybe at a later date, you figure out, you know what? I go to Starbucks and spend $30 a week on Starbucks. Maybe I'm going to cut that back. I'm only going to go 3 days a week and spend 15 instead. It's up to you. This is your plan, but these are the different places where we're going to find money. And the whole goal is we're going to be able to put you in a situation where you're going to be able to move forward and eliminate that debt without you spending any more than you're currently spending now. Remember that. We're not creating a new bill for you. We're just changing the way you spend money. So side by side, where you are most likely is on the left side of your screen. The average household debt being $250,000. And these are all the numbers we've already talked about. 34% you're spending in interest over time. 40% is what you're going to spend in taxes. 23% is what you live on. And then hopefully you're saving a little bit of money, and that's your savings amount. What we're going to do is we're going to soup up your plan, and we're going to put you on the straight and narrow so that you will have enough for retirement. You will have more spendable income. You're going to pay less taxes to Uncle Sam, and you're going to have a significantly lower amount of money that you're spending on interest. And all those other reductions that we're going to have are going to translate into dramatic increases specifically in your retirement. And if you look at the screen from left to right, moving from 3% to a 15% amount of every dollar you spend as savings, that's a 500% increase, folks. That's 500% more for retirement than you had right now. And when we said earlier, the average American saves $60,000 for retirement, that's a huge jump. That means we're going to jump you from $60,000 to $300,000. And it's a whole lot easier feeling knowing you've got $300,000 sitting in an account, earning interest, paying you potentially regular income as an additional income stream than looking at $60,000 and wondering how long is that going to last. Taxes, we're going to reduce the taxes you pay over time by 25%. That's a huge number. We're going to decrease the amount of interest you pay by 43%. That's an even bigger number. But the most important number here really for people when they first start these plans is their lifestyle. We don't want you to see a significant change in how much money you're spending per month. We don't, unless we can increase that. And the way that we do that through this plan is we're going to increase your cash flow as well. That 10%, 23 to 33%, that actually represents, what is the number? 43%. It's a 43% increase in your spendable income. So think of it like this. After you've executed the plan and you normally have $1,000 a month left over in your bank account every month, what if that changes to $1,430? $430 makes a lot of difference to a lot of people, myself included. So this is something that if you follow the plan, it's structured, And you can certainly change it. It can be modified as you move through time, and you will change it. But if you follow the plan, then you'll get the result that we tell you that you're probable to get moving forward. So how do we do it? Obviously, we're going to reduce the amount of interest you pay over time, reduce taxes. We're going to eliminate your debts. We're going to use the debts that you had to help fund your plan, improve your cash flow. And that last one I love, allow you to retire with a tax favored income. And let's be clear about this. It's not tax favored like a 401k is tax favored. It's a tax exempt income. There's a huge difference between tax favored and tax exempt. So am I telling you that you can derive income from this without having to pay taxes on it? Yes. And the beauty of it is you don't have to wait for the IRS to tell you that you can do it. The IRS isn't going to tax you on it ever. They're not going to penalize you if you take it too soon, and they're not going to force you to take it at a certain age if you're taking it too late. The IRS has no control and no ability to manipulate this against your wishes. So let's move forward. One of the reasons I mentioned that this is not a new concept. This uses two traditional financial concepts. One's called infinite banking and the other's called debt snowballing, true debt snowballing. So there have been other iterations before Symmetry's version of this previously. And those other iterations had different degrees of success. So what Symmetry did is we took a look at those other solutions and realized every one of them has an Achilles heel somewhere. And one of the critical Achilles heels with all of them is they didn't really plan for the emergency. So with our system, we absolutely have an emergency fund built into the system, and it's not money that you can see. It's there. It'll always be there, but it's not money that you can see. And it's money that creates, again, part of that fuel for your plan where you're getting this guaranteed return, in some cases a monthly compound return plus a dividend at the end of the year. But it's money that is certainly there. How much is it? Well, we look at this as we call it the 20% rule, the 80-20 rule. So you're going to have a specific amount of money that's going to build up every month in your account and your plan. Whatever you see represents 80%. And there's an additional 20% hidden. It's still there, but it's hidden so that we don't want you to be tempted at some point to use it. It's an emergency fund. It's a true emergency fund. It's not I need a new jet ski emergency fund, or I need to take that trip to the Bahamas emergency fund. It's a, holy cow, my roof just left. Holy cow, I need a new car because I just dropped my transmission. Holy cow, my parent is ill and I need to go spend time with my parent. It's a true emergency fund. So moving forward, when we compare this scenario versus traditional retirement vehicles, paying tax, putting it in a savings account, earning what you can, putting it into a 401, deferring that tax, or doing what we do, which is a tax-free solution. When we run those numbers in the three different scenarios side by side, using the exact same parameters, $10,000 invested, 28-year run on the plan, an average of a 7% interest rate, and looking at a 25% tax rate when you actually realize the gain, then hands down, every time this plan is gonna outperform those other two vehicles simply, simply because we're not growing the tax that we owe. Sorry about that. So I'm gonna take a little drink here. All right, so we're not growing the tax. So for example, if you have a traditional IRA that you think is doing well, and you're earning 10% per year, guess what? The tax that you owe is growing 10% per year too. So are you really earning 10%? You are not. You're earning something like 6.5%, 7% at best. So traditional IRAs cannot outperform this vehicle when you compare them side by side if you run it for about 20 years. When I've run the numbers, what I've seen is in a 20-year run, this plan will outperform an IRA, a traditional IRA, 17 out of 20 years. And in the end, this plan will have significantly more left in the coffer than that IRA will. So how does this plan work? Plan works in three phases. The first phase is called the maximization phase. And what that is, that's where we are maximizing the elimination of your debt. And we're using that debt to move into the second phase, which is the accumulation phase. And that's where we're growing as quickly and as large as we can the retirement that you have. Again, tax-free retirement. I can't say that enough. Tax-free retirement is huge. So maximization, we're maximizing your growth potential and the debt snowball in here, using your debts as the vehicle, paying them off as quickly as we can, and then recapturing that money that we spent to eliminate that debt. Accumulation phase, this goes on as long as you want until you want to retire. The plan I did yesterday, person's going to retire at age 50. They're going to have over $600,000 in their plan at age 50, and they're only doing $150 a month. Next and last, and the most fun, the distribution phase. And that distribution phase, that is where that emergency jet ski purchase is available to you, because it's your money, it's your retirement. Do whatever you want to do with it. Spend it wisely, or maybe not. Have fun, whatever. It's yours. Do what you want to do with it. The point is that you have freedom, and it's true freedom. Again, no IRS entanglements. One other critical thing about this plan that I want to make sure everybody understands, this is tort proof. So even though you may have a significant sum of money stored in this account, you cannot be sued for this. A judge cannot force you to liquidate this account. You cannot, if your best friend wants to sue you because you wrecked his car or her car, okay, but they can't list this as something where they're going to go after or pursue to be made whole. The point is, it is tax exempt. Moreover, it is tort proof and IRS proof also. Moving on. So I mentioned earlier, this is not a new concept. This has been around for a long time. Walt Disney used this when he originally started Disney World. Why? Because he couldn't get people to lend him the amount of money that he needed to build the facilities. However, he had a large sum of money to start with, so he was able to leverage that money through the use of wasn't called debt-free life back then. It was called a participating whole life policy, which it still uses that these days. But the point is, he used it. Doris Christopher used it with Pampered Chef. Ray Kroc did it with McDonald's, and Warren Buffett does it to this day. There's nothing quite like recycling money and using it over and over. And the banks, by the way, we'll get this in a minute. We'll get to in just a minute. The banks love you for allowing them to recycle your money and use it over and over again without paying you anything for the use of that money. So on behalf of all the banks, thank you for being a lamb and a lemming. So let's move forward here. So how do we do this? We use a life insurance policy. It's nothing more intricate than that, other than this life insurance policy does have two pretty unique riders on it, which allow us to use it in the capacity that we're trying to do. We don't ever take the money out of the policy. We leave all the money that we put into the policy there forever, and it grows. Every time you make a premium payment, it grows and grows and grows. The only thing we ever do is we pull a loan from the policy. So I keep talking about how this is tax exempt. That next line, no penalties, no tax, right? So let me ask you this. When you took a loan to buy your car, did they tax you on that loan? When you took a loan to buy your house, did they tax you on that loan? There are no loans. There are no taxes on loans, folks. So that's one of the reasons why we do these things the way that we do them. We're going to take a loan against the value of our life insurance policy and pay it back maybe if we want to, maybe not. All those other things are critical. They're all important. We're going to demonstrate all that stuff here in just a few minutes. I'm going to give you a couple of examples. But that one there, that finance future purchases, I do want to hover on that for just a second. I had one of my recent clients was did one of these plans, and between the time that we executed the original application and the time where we actually were able to put the policy in force, she'd incurred an additional debt. So this is something I'm going to tell all you folks. These plans work better for the numbers of debts you have, not the amount of debt. So if you've got 6 debts, great. If you've got 12 debts, even better. And what she did, she actually created another debt. And simply by creating an additional $6,000 debt, going to buy a water softening system for her home, simply by creating an additional $6,000 debt, she made her plan work 2.4 years faster. So it got her out of debt from, instead of 12.6 years, it got her out of debt in 10.2 years. And she also created in 30 years an additional $180,000 of retirement. That's the power of compounding associated with debt snowballing. And so you guys should be shaking your head just like I was when I first heard this. Oh, this sounds like there's no way this is true. It's this guy trying to sell me. It's all no, it's real. It's real, folks. I've been trying to poke holes in this thing since the first day I heard about it, and I can't. And I'm a very big fan of Warren Buffett. If he says it works and he does it, I'm following his suit. All right, so moving on. So Symmetry started this program in June of last year. These are just some of the folks that we've been able to help. And those numbers, to be honest with you, that's really, really light. Okay, I'm used to, most of the people I deal with have somewhere between $250,000 and $1 million in debt. So when I run into that person with only 84 or only $73,000 in debt, great, we're going to get it done and we're going to hammer it out quick. But the point is, the more debt you have, the faster the plan works, and the more money it's going to create for you as far as retirement is concerned. So let's talk about how it works. First off, let's analyze how you do it. Okay, so this is how you currently spend money. You work your job, whether it's a 1099, W-2, W-4, work for yourself, whatever. You make your money. And then in that process of making money, you got to have a place to put it. So you deposit that money, your income, into your bank, Wells Fargo, Citibank, whatever. And Citibank or Wells Fargo thanks you for putting your money in their bank, and they thank you by saying, you know what, you've got over $2,000 in our bank right now. You don't need to pay us to use our bank. What? Yes, I'm putting my money in their bank, and they're telling me they're not going to charge me to put my money in their bank. What are they doing with my money? Well, they're using it over and over and over again. They're using it over and over and over again. And in the process of using it over and over, they're lending it out every night. Sometimes at the federal funds rate at only 1% or 2%. And sometimes they're using it as loan money for short-term high interest loans, making 22, 24%. The point is, they're making a ton of money with your money, and they're not giving you a dime. In the end, you end up saying, wait a minute, I still have to make my car payment. So let's go ahead and I'm going to tell the bank I'm going to write a check, or I'm going to go to my bill pay system. I'm going to tell the bank to go ahead and pay my debt. My money is going to be transferred out of my bank, and it's going to be transferred to that company that lent me the money for that car. And now my money has become their money. And if I'm really, really nice and really sweet, and I ask them really, really in the best way possible, can I have that money back? The answer is going to be no. My money is no longer my money. My money is now their money, and it's gone forever. So in this process, I've used my money one time. I haven't made any money with my money. All I've done is pay some of my debt. There's a better way. This is the better way. Hands down, the best way possible. Nothing changes with how you make money. Nothing changes with what you do with the money. You take that income and you put it up into your checking account. Nothing changes there until we get to this point. So instead of leaving our money, we're going to leave some of it, but instead of leaving all of our money in our checking account, letting that bank use it over and over and over again, I'm going to take out a life insurance policy. What kind of life insurance policy? Specifically a whole life insurance policy, but it's a special kind. It's called a participating whole life insurance policy. That's the second time you've heard me use that word, participating whole life policy. Why participating? A participating whole life policy means that you get to participate with the profits of the company that you have that life insurance policy with. So does anybody have any doubt that insurance companies are, if not the most profitable type of business on the planet, certainly one of the top 5 most profitable types of businesses? So what does that mean? Simply by taking out a life insurance policy, which happens to be a whole life policy, you get to participate with that carrier's profits. One more comment on this. The reason why we chose the 3 carriers that we did is because all 3 of these companies happen to be what's called a mutual company. So what does that mean? In a corporate world, a mutual company is a company that's given a tax-favored relationship with the IRS at a corporate level because they've agreed to pay out a larger portion of their profits to their shareholders. And what did I say happens as soon as you become a policy holder with this company? You get to participate. Why? Because you become a shareholder. So that means with these 3 mutual companies that we use, you get to become a shareholder with those companies, participate in their profits, which means you get to make money with your money over and over and over and over again. Now, I mentioned that there's 2 other parts to this. Whole life is the base policy. Let's talk about that term life for a second. That term life policy is a rider, and there's a reason why we have it there, because this goes into the IRS tax code. IRS tax code 7702 says any money is derived from a life insurance policy is tax exempt. It also says if the cash value of a life insurance policy exceeds the life insurance value of the life insurance policy, that policy is no longer life insurance. That policy becomes what we call a modified endowment contract, a MEC. And as a MEC, the whole thing is taxable. So the game is over. So the reason why we have that term life rider on this policy, and in many cases, I've seen that term life rider 10, 20, sometimes 30 times the size of the base whole life policy, so that we can create this umbrella, this life insurance umbrella, so that when the IRS comes snooping around and looking at our policy, all they can see is this life insurance policy, this massive life insurance policy. They can't see the cash that we're growing underneath it. And that term life policy is temporary. It's temporary to the point where we build the cash up to the life insurance policy beyond the period of time where the IRS can look at this. And then we say bye-bye to that term life rider because we don't need it anymore. Okay. In addition, the third part of this plan is a paid up addition. All right. So this is the hard concept to understand about this whole process. I'm buying life insurance. I'm sending a single premium from my checking account to buy a life insurance policy. That life insurance policy is composed of three parts. It's the whole life base policy, the term life rider, and the paid up addition. And when I structure these things, I'm actually spending more money on the paid up addition than I am on the term and the whole life. Why? Every time I buy a paid up addition life insurance policy, it has permanent value. What does that mean? Okay, if I buy $1,000 of paid up life insurance, tomorrow it's worth $1,000. Next month, it's worth $1,000. 10 years from now, assuming I'm still alive, it's worth $1,000. When I die, it's worth $1,000. The price, the value never changes. More importantly, I have to spend zero to maintain the value of that policy. It is permanent. Okay. So in banking terminology, we call that a tier one asset. Tier one, tier 2, tier 3, tier 4. So what's the difference? A tier 4 asset is a very high risk asset. That might be like a loan that you lend. Sorry, 20-year-olds, a loan that you lend to a 20-year-old to go open a brand new restaurant, knowing that those have a 95% failure rate in the first year anyway, and you're going to give $1 million to a 20-year-old to go open a restaurant because they've been a busboy before. Really, really bad investment. Really, really bad idea. Okay. The reason why banks like this particular type of investment, a tier 1 asset, is because it has a guaranteed value and has low cost to maintain that value. So in this case, we have zero cost to maintain the value. We know exactly how much it's going to be worth, and we know that no matter what, this will always be worth that money. So what does that mean? That means Wells Fargo, JP Morgan Chase, SunTrust, Citibank, the largest banks in the country, have 48% of their assets structured in this exact thing, which is paid up life insurance. So you may or may not have heard of those companies that are out there called viatical settlement companies. They go around and buy life insurance. Why? Because it has value. They pay pennies on the dollar, and then that's how they increase their value. So those paid up additions, if the banks are doing it, why not you? So if you buy $1,000 worth of life insurance, it's worth $1,000 today, you never lose value. So what happens? Earlier in the previous screen, I showed you that the banks were using your money over and over and over again and making money with your money. And so what we're going to do is we're going to tell the banks to pound sand. And we're going to go ahead and take that money, and we're going to be making the money with our money over and over and over again. And we're going to take our money, instead of putting it into the bank, we're going to put it into our bank. We're going to put it into our DFL, our debt-free life bank, and we're going to keep that money there forever. Remember earlier I said that you never actually withdraw principal? You don't. The only thing you ever do is take a loan, unless you have that true emergency, and then you can take out money from that 20% emergency fund. Okay? So we're going to sit there. We're going to make money with our money over and over and over again. How? These companies that we use are mutual companies, like I said earlier. So they pay a very high interest rate. What's that? Well, all the three companies we use guarantee a minimum of a 4% return. Some of the companies we use actually pay a monthly compound of that 4% interest rate. And then on top of that, they also pay a dividend annually. So when I'm looking at this, for example, if the interest rate is 4% and the dividend is the worst that it's been in the history of these companies, by the way, all three of these companies have been around for at least 100 years. They have paid a dividend every single year they've ever been in business, which means they've been through every pandemic, every good president, every bad president, every war, every policing action, every modern war, since the 1900s. They've been here, they've done it, they've seen it, and they've still paid a dividend, right? That's why we like them. They're also A or A plus rated. So we know they're going to pay us money. We know it's going to be a good return. And we know we're going to make money with it all the time. And then when the time comes, I need to make my car payment. Well, in this case, let's say we're going to pay off our car. Let's say we have to pull $1,000 out. So what do you do? How do you do that? You tell the carrier, I want to take a loan against the value of my policy. This is nothing new. Everybody's heard about taking loans against their TSPs and their 401ks and taking loans against their whole life policies that have a cash value, but you've never taken a loan like this because the guaranteed interest rate plus the dividend 17 out of 20 years is going to be higher than the interest rate they charge you on the loan. So one of the questions I get all the time, well, if I take a loan out, I got to pay it back, right? Nope. The dividends are structured to pay back the loans over time. Yeah, you should be having a holy cow moment right now. So we take that carrier loan. We take that $1,000. Our $1,000 is still sitting in our bank. We haven't touched it. It's still there. It's still earning interest, even though I've got a loan. I take that $1,000. I tell my bank to go ahead and pay that debt because I take that $1,000, put it back down in my checking account. I pay that loan. The loan's gone. The debt's paid. Where's my money? My money is still sitting in my DFL bank. I haven't touched my money. I've used the carrier's money. And at the end of the year, when I get a dividend, guess what? Depending on how far along in this policy process I am, the chances are likely that there's going to be enough dividend in there to pay back that loan. This is the debt-free life method. This is the method that I'm going to tell you is the best that I've ever seen. I'm doing it. Everybody in my family's doing it. Pretty much everybody I talk to, I've only met one client so far that isn't doing it, and that's because they can't, because they really need to be declaring bankruptcy. They've got too much debt. They can't support their current debt service. All right. So let's look at some examples. So here's one of the first family. Well, first, this is a family I helped back in October. This is a standard family. They were both previously divorced, so they had two homes. So that's why you see a personal residence and an other property note here. And they have a fair amount of debt, including 40 years of debt. Why? Because the wife is a doctoral student, and she has a tremendous amount of student loans, most of which are in deferment, and has a lot of debt. This is what it really looks like. So in this situation, if they had $585,000 sitting in their checking account, they could simply write a check and pay off all of their debt. They don't have that money laying around, which is why they had to finance their debt, which means when we look at their true debt, it's not $585,000. It's $767,000 because they owe $182,000 of additional interest. That's vicious. Student loans are vicious, folks. They serve a purpose, but don't let them hang out because they will eat you alive over time. So what did we do for them? Well, we went through, looked at how much they were over contributing to 401ks, looked at replacing some life insurance, looked at where they were overpaying their debts because they're trying to get out of debt fast. And we created a plan that got them out of debt in 7.8 years. This is not abnormal, folks. This is normal. And it is not too good to be true. And this, if you notice, this doesn't do what most people's concept of debt snowballing is. We're actually paying off a 0% interest debt first, which most people's inclination is to take the highest interest rate thing and pay it down first. Rest assured, for those of us that do these plans and have the software to do this and have spent the thousands of dollars that it takes to learn how to do this and buy that software, There is an absolute best way and an absolute fastest way to get out of debt. And there is an absolute best way and an absolute fastest way to create the largest amount of retirement income. There's only one way. And this system, the software, figures out that way for us. I'm a math guy, so I tried to do this one time on my own. I did figure it out. It took me about 18 hours of math, running different iterations to figure this out. I'd much rather spend the $5,000 for this piece of software, press a button, and have the answer in 30 seconds. Okay. So if you're really, really bored, go try to figure it out yourself. Otherwise, contract a Symmetry agent that's certified to do this for you and have them do it for you. Anyway, we went from 40 years to 7.8 years. That's huge. $70,000. We saved them $70,000 in interest. That's pretty big. Remember what we said earlier? We were going to reduce the amount of interest you paid from 40% to 30%. Yeah. Well, this is significantly more than 40%, right? So when the decision came for them to pull the trigger or not to pull the trigger, I showed them this single page. 40 years of it, 40 years to pay off your debt. In the end of 40 years, what do you have? You have zero debt. You've paid $182,000 in interest. You have 100% equity in 2 homes, and you have zero additional retirement. Using our plan, you get out of debt in 7.8 years. We save you $70,000 in interest. You still have 2 homes with 100% equity. And oh, by the way, we created an additional $4.8 million in retirement that is tax exempt. Okay. We also, as a byproduct, because don't forget, remember at the beginning of this is a life insurance policy, right? So we've created a life insurance policy that is fully paid up, that you never have to pay another dime for. So when you combine the cash value of this plan with that life insurance policy, the family's benefit is $5.96 million worth of life insurance plus cash. So one of the things I haven't said yet, and I'm going to say it now, the reason why the wealthiest people in this country use this vehicle over and over and over again, not only to create wealth within their family and create retirement within their family, they use it to create generational wealth. They use this as a vehicle to transfer wealth from generation to generation without having any IRS intrusion, without having a tax issue. Because look at this, that $4.8 million, what happens if I take out $1 million as a loan? Do I owe any tax on it? Nope. And I put it in my account, and all of a sudden I gift it in the form of another life insurance policy to my great-grandson. And I buy a great-grandson a life insurance policy that's fully paid up, and I pay with it $1 million cash. How much is that going to be worth when he's ready to retire? This is how you create generational wealth, folks. So let's look at the actual mechanics of how this worked. So in this first scenario, you see that the policy year 1, the annual liquidity at the end of policy year 1 is plus $12,000. But look at that middle column, loan from CV, loan from cash value. Not only is there $12,000 sitting in that account at the end of the year, they also paid off almost $15,000 in debt. Now, whose cash did they use to pay off that debt? The carriers. Where's their money? It's still sitting in the policy earning an interest rate. What happens next year? Well, next year we do it again. And the next year we do it again and again and again and again. So look at this. In the 4th year, we're not ready to pay off any of those debts because the actual cost to pay off one of those debts hasn't come down far enough to the point where the cash value of the plan has reached up and met the debt. So what happens? We grow to $91,000 cash in the account after 4 years. And then we move forward. In the next year, first month of the next year, we take out $96,000. We pay off $96,000 worth of debt. And at the end of that year, we still have $61,000 left in our account. You should have lots and lots of holy cow moments here, folks. This should be blowing you away. When I first saw this, I said, there's no way this works. It's a lie. It can't work. The math doesn't lie. The mechanics are simple. The concept is difficult to get your head wrapped around, but once you get it, it's great. A couple more things I want to show you. At this point in year 8, which is 7.8, we've paid off that debt. House is gone. Now the plan is on automatic pilot. So look at this. In year 9, I contributed $32,000 in premiums. Okay, 175,000. In year 10, again, $32,000 in premiums, 272,000. Did I grow only $32,000? Nope. What's causing that growth? That's being caused by the effect of the compound interest, the dividend, and also the debt snowball. So this individual told me that he wanted to retire at 75. So we said, okay, retire at 75. But let me show you one thing. What happens if we don't wait to 75? Let's say we retire at 60. At 60, you'll have $2.2 million liquid cash sitting in an account. Do you think that's enough to retire with? Yeah? And oh, by the way, 2.2, right? At age 60? How much death benefit does he have? 2.5 million. You guys get it? Talk about a legacy for the family, right? 2.2 million cash in an account and 2.2 million life insurance. And oh, by the way, if he decides he wants to stop doing this, the life insurance continues to grow. Age 70, 76, he's no longer paying for it. Where's the life insurance now? 3.3 million. What kind of legacy are we leaving for our family now? Okay? So, folks, this is not rocket science. It's not magic. It's just math, and it works. I promise you it works. And if you don't believe me, talk to a Symmetry agent, broker, underwriter. Get them to run this stuff for you. Let them prove it to you. All right, so let's move on. What happens if you have somebody who doesn't have a whole lot of debts or a lot of debt? They don't own a house. So here's a student that I worked with. She's 23 years old. She's in the master's program at Cal Poly right now, studying marine science. And she is a whole lot in debt for someone as young as she is. She is $88,000 in debt. And that's because of those vicious things called student loans. She got a little bit of car payment. She's got a vet bill. She's got a hospital bill. Everything else is a student loan. So when we're looking at our student loans, which are all in deferment right now, right, they're still growing though, right? And then she's adding more student loans. So as we go through this process, if she wanted to, she'd be out of debt in 40 years. That means that in her current situation, she could pay on these debts for the next 40 years, have them be completely paid off, and have nothing left to show for it. No equity and no home, other than the fact that she's got her degrees paid for, right? Look at that, $85,000 now, but the reality is she's going to pay $177,000. She's paying more interest than she is in principal. I hate student loans, folks. I hate them. They're evil, right? So moving on, this is our plan for her, 9.7 years. How can she afford this, you say? Well, she works. She works part-time. She's a waitress. She makes about $200 a night, working 2 nights a week. So basically, one weekend, she makes enough premium to pay her bills. This is a $350 a month plan. And to be honest with you, a $150 a month plan, it only takes 0.6 years longer. So don't be fooled. The only difference with the larger initial premium is you get a larger retirement in the end. So how'd this work for her? 40 years, 9.7 years out of debt, $64,000 in interest saved in 40 years. So she can do her plan, be out of debt in 40 years and have nothing to show for it, or she can do our plan, be out of debt and have $603,000 sitting in an account for her, plus over $400,000 in paid up life insurance that she never has to make a premium payment on the rest of her life. So at 23 years old, she set her family up with a little bit of money for generational wealth. Here's how her plan worked. Same deal. We're paying off a debt every year, every other year. We got a couple of years where we can't pay off any debt because the next largest debt to pay off is too large for our plan to hold. She said she wanted to retire at 65. Nope, we got her retired at 55. So at 55 years old, she makes her last premium payment ever. And if she wants to retire at 55, she's got $409,000 in there. Do you think she can make it off $409,000, assuming she never, ever finishes her degrees, never takes a job doing anything other than a waitress, and never makes any more money than she's making right now? Are any of those assumptions realistic? Probably not. So the idea here is, folks, she gets to that point relatively quickly. And that's because of the debt snowball and because of the guaranteed interest rate compounded, and because of the dividend. Moreover, in year 56, at age 56, she's no longer making premium payments. Look at that death benefit. It's still $685,000. She's not making a premium payment. It's permanent, and it goes up every year simply because of the compounding effect. Look at that cash value. It's going up every year. She's basically making $22,000 a year every year for the rest of her life, starting at 56, tax-free, which means what? That means it's the equivalent of probably about a $35,000, assuming the tax rates don't go up. Does anybody out there think the tax rates aren't going up after we spend the next $1 trillion after the $2.2 trillion we spent 6 months ago or 5 months ago? So her plan flies. And flies and flies. And this is not abnormal, folks. This is everybody. So one of the things I want to stop sharing in just a minute. One of the things I want to talk about is there's this concept that that we use with debt-free life campaigns, if it's appropriate. And originally I was discussing these things as what we call debt, as mortgage chunking. All right. But what that really, it's kind of a misnomer. You can actually chunk any debt. It doesn't have to be just mortgage. But if you chunk mortgage, if you chunk your mortgage, if you have a standard mortgage of $225,000 and you use a DFL plan, just a basic DFL plan, somewhere between $150 and $500 a month starting, doing a mortgage chunking routine will get you out of debt 10.6% faster. So if you're out of debt in 9 years, well, you're out of debt in 7.7 years, whatever that number is. Okay. So I'm going to do a little bit more presenting here. I want to show you a little mortgage chunking piece. Let me get that set up for you. Okay. So this is mortgage chunking. So that family that I showed you earlier with the $225,000 of debt, I used them as an example here too, to show you how mortgage chunking would have affected their plan. So this is the same. You've already seen this. You've already seen this. You've already seen this. Yep, nothing new. So mortgage chunking. How do we do mortgage chunking? So the way we do mortgage chunking, we're going to assume some basic assumptions of this this house. The house these folks had was a $225,000 house. Okay, or actually $215,000, a 30-year mortgage. And their basic debts, most of their debts were paid off in about 2 years. There were a couple of larger ones, but most of their smaller debts were paid off in 2 years. So what that means in our plan is that having those basic debts paid off, every time we pay off one of those debts, we're able to add more money through our debt snowball process so that we're making larger and larger premium payments up into our life insurance policy. What that created was an additional $10,000 paid up addition purchases per year. PUA, remember? 3 parts to our plan: whole life, term life, and paid up additions. So that means we're purchasing $10,000 more in paid up additions. What does that mean? That means we're throwing in $10,000 more permanent asset every year, and we're going to take loans from it. How's it work? Here's the actual amortization schedule for that family. And I want you to pay attention to the top. So if you've ever had a mortgage and you signed that big thick stack of documents called your amortization schedule, and they told you, yeah, you got a great interest rate, it's 3%, it's 3.5%, they were lying through their teeth. And they know it, and now you know it, because your very first interest payment was 74.71% interest. And it doesn't get any better any sooner. Not really. Realistically, you're going to be paying more mortgage than principal on every single mortgage payment until you're about 20 years into a 30-year mortgage. It's sick. As a matter of fact, the only time you're going to be paying the interest rate that they quoted you is in the last year of your mortgage payments. That's the only time. So it's a sick lie, but they all do it, and we're supposed to be educated consumers and know they do it. So be it. So here's our mortgage. Pay attention to a couple of things. First off, our mortgage balance is $214,000. We're paying $288 in principal on our first payment and $850 in interest on our first payment. So we're going to accelerate 5 years. So 5 years, we've got our plan. We've gone through most of our debts. We're building up cash value, and we've got the opportunity. We've got $10,000 extra sitting in our account right now. It will not take this long, folks. Actually, 3 years. This is realistic. So we've got $10,000. Just through the normal process of paying our mortgage payments, we've paid our mortgage down to $203,000. Okay? So now we take a loan from our bank. We withdraw $10,000 out of our bank, and we pay $10,000 to our mortgage company. And we make sure that we identify on that check that this is to be applied to 100% principal. You're not paying any payments in advance. Make sure you do that. Otherwise, they'll do what's best for them. So we've changed the amount we owe from $203,000. Pay attention to this. $332 is our principal payment. $87 is our interest payment. We just stroked a check for $10,000. Boom. So we're now at $193. So what happened? We're also now in 2025 in our schedule. So a single $10,000 payment accelerated us 22 months into the future. So we essentially paid off 22 mortgage payments with one $10,000 payment. What else happened? We saved $27,000 of interest. What else happened? On this payment and every payment in the future, we made it more efficient. So instead of paying $332 of principal, we're now paying $372 of principal. So we've increased the efficiency by 11%. Our mortgage payments are now 11% more efficient making principal payments. We've eliminated $27,000 of interest. We've paid off 22 months of our mortgage, and that was just with one $10,000 tranche. What happens if you do this every year? This is what mortgage chunking does. This is why mortgage chunking makes your plan fly 10% faster. So that's the end of this little mortgage chunking presentation, and that's the end of the Debt-Free Life presentation. At this time I have, yep, right on time. Got about 13 minutes, Tom. Let's open it up for questions, see if anybody's got any. If you've got any, let's see if there's any in the chat window. Which company or companies pay the monthly compound, and what is the maximum guaranteed interest for these companies? Great question, Erica. Mutual Trust is the only one that I know that pays a monthly compounded interest rate. The highest guaranteed interest is probably, well, they all guarantee 4. You'll probably get the highest interest rate with Foresters, because Foresters does theirs a little bit differently. They actually they add the guaranteed interest rate plus the dividend into one payment a year. All right, and that's the only question I see in chat. So does anybody else have any questions? Did I explain it all very clearly? Fairly clearly.
Where do I sign up?
Come on, Michael, what'd you say, buddy?
I said, where do I sign up?
Where do you sign up? Contact whoever invited you here.
Me.
Get started sooner than later. Are you licensed?
Yes.
What are you waiting for? Go write one on yourself. Get appointed with Mutual Trust and do it.
Michael, have you been through the DFL training yet?
No, I saw this.
You gotta get certified.
Hang on just one second.
Yet.
Hang on just one second. Hold on. Nancy, unmute yourself. Did you go through DFL training virtually last week?
Yes.
How did it work out for you?
It was mind-blowing.
Would you recommend that Michael sign up for the training in August?
Yes, definitely.
Okay, good. She's the first person I've talked to that's been through the virtual boot camp. And Michael, of course, got to check with your upline, make sure it's part of their game plan for you. But I
did it virtually too, and it's
how I got here. Actually, my upline was like, "Hey, we're doing this. Go check it out."
We're doing this, and you're doing it too. There you go. Right on. Yeah, good stuff. All right. Does anybody have any questions about the policy, how it works, the mechanics? I know it's a ton of information.
Can I ask a question?
Of course.
I'm not clear on the tax advantages. Can you kind of go over like the tax?
Here's your tax advantage.
I know, but like where are they saving the taxes?
So if you're like most Americans in the 25 to 48% tax bracket, you just save 25 to 48% on your retirement income.
That from like money that they get from their 401k and their IRA.
Yeah, well, their 401k money, depending on how long it's been in there, there's potentially different tax rates and also different tax brackets. So there's no way if I have $1,000 in this or $1,000 in a taxable retirement vehicle, when I take the money out of the taxable retirement vehicle, I'm gonna have a tax obligation. So I may take out $1,000, but I'm probably gonna owe another $280 in taxes, which means my net return is $720. So I'd rather have $1,000 than $720.
Thank you.
And that's hard, fast math, but that's basically how it works. Okay.
Hey, Scott.
Maureen?
Yes.
Points?
Yes.
Did I say it right?
You did.
Okay,
Thank you.
I'm going to educate Kevin Purdy on how to say your last name.
Well, he can't tell you because he doesn't know. He makes it 4 syllables. It's only 2.
Yeah. Yep.
So I recently heard it put this way. Would you rather pay taxes on the seed or on the harvest?
Yeah. Good.
So, when you put that money in, you're getting a very small tax break if you're putting it into a 401k. But when you take it out, you're paying a huge amount, especially if you put it in the right kind of funds over your working career.
Yep.
So having done it the other way, I paid, I put it in, and so now I'm paying taxes when I take it out on the harvest. I don't like it, but nobody told me that 40 years ago. So, and I wasn't smart enough to figure it out.
That's a good observation and a good point. And that's a good way to think about it. But at the end of the day, for me, I'm a math guy. I just want to see the math. And when you see them side by side, there's no comparison. These plans blow. First off, these plans blow away 401ks, but they also blow away IRAs, even Roths. They blow away other types of retirement vehicles, IULs, index universal life policies, which have their place. But this is, I haven't seen anything like this. And I've been looking, and I can't find anything better. All right, we got just a few minutes left. If anybody else, raise your hand. Otherwise, I'm going to say thank you. Oh, Taylor. Hey, Tay. Tommy, did I miss anything?
Not that I captured, bud. You did, as normal. You did a fantastic job.
Okay.
Appreciate you.
All right. Well,
appreciate you taking the time.
My pleasure. The last part of this is a call to action. If you think that one of these plans would be a good solution for you, get with whoever invited you here and pursue that. If you're an agent and you want to start offering these, take the training, get certified. Be prepared though. The software is expensive, and part of that certification process is you have to have the software. So be prepared for that. And that's it. I wish everybody the best of luck. And we'll be back here next week, and we'll be doing something a little different next week. Still DFL, just a different concept for DFL. So I'll talk to everybody later. Have a great night.
Thank you, Scott.